Here we're dealing with an asset sale. So when we say an asset sale, we're typically talking about some real asset that the firm has either acquired or created in the context of a project that it ultimately sells off once it's no longer useful to the firm. And so we need to understand what the cash flow implications are for such a sale and include them in our incremental cash flows for NPV analysis. And so first of all, there's the inflow associated with the sale itself. Okay, so that's pretty straightforward. So in this problem, if the firm is selling the machine for $200,000, it's a $200,000 inflow. It's a little tricky, though, when we start thinking about tax implications. Okay, so tax implications from asset sales will arise because firms typically are going to depreciate or write off the cost of assets over their useful life. And so when a firm sells an asset, then we need to figure out what the asset is currently worth on the books and determine whether or not there's a gain or a loss on the sale. And so for the tax implications that we're interested in here, we simply need to compare the sales price to the book value at the time of sale. And if the sales price is greater than the book value, we have a gain, and that gain is taxable. Of course, if it's a loss, we would be thinking about a tax credit. Right? So how do we find the book value at the time of sale? So the book value is going to be the historical cost less accumulated depreciation. So we just need to figure out what each of these numbers is in the context of the given problem. So historical cost is going to be whatever was paid for the machine. So there's the historical cost. So that's going to be $250,000. $250,000 goes there. Accumulated depreciation is just going to be a function of the depreciation schedule. And so let's look at the depreciation schedule for this problem. We've got straight line over 10 years with no salvage value. So the full $250,000 is going to be depreciated evenly over the next 10 years. So annual depreciation is 250,000 divided by 10, or $25,000 per year. How much time is going to pass before this thing is sold? 3 years. And so accumulated depreciation then is going to equal 3 times 25,000, or $75,000. Okay. And so back to book value then, we have $25,000 minus $75,000. So book value is going to be $175,000. Okay. Now we're pretty close to being done. Okay, so what is the gain or loss? Well, here we are selling for $200,000 and it's worth $175,000, and so we have a taxable gain, and that is $200,000 minus $175,000, or $25,000. So that amount is taxable. Okay, so we know the taxable amount. And so the tax is going to be the tax rate of 20% times the gain. And so that's going to be $5,000. Okay. And then finally, what is the cash flow? The cash flow is the sales price, $200,000, minus $5,000 in taxes, or $195,000. And there is the number that we are looking for.